Please welcome the panel on the future of venture capital, AI, IPOs, and tech investment, moderated by Romaine Bostick, TV anchor at Bloomberg.
Future of venture capital, they make these things so broad. I mean, we can kind of go anywhere with this, and I don't know if we want to hit the ground running in the same way that Brendan and everyone in Washington has. Has the chaos in Washington, have you felt that in your businesses at all, or is that just so far removed from what you do, Raj?
I think for us, as venture capitalists, we take a very long-term perspective on our investing. So I think in the immediate term, we're much more focused on new fundamental technologies that we think are fundamentally transformative. But of course, exit markets, IPO markets are much more closely related to public equity markets, so we absolutely pay attention to it.
When we talk about sort of the big fundamental and structural investment opportunities in the VC space, and I'll just go down the line here with you, Amir. I mean, what is the primary thing that you're looking at right now?
Well, we're focused on exponential technologies, which actually ends up involving a lot of hardware componentry. So for example, robotics, for example, alternate computing systems and things of that nature, communications gear. And one of the things that is causing some volatility, let's just say, in planning is just, how these tariffs shape out. We'll see. Right now, there's a tactical effect that we already see on some of the equipment that's being brought in. Our goal, of course, is to manufacture it in America, but the global supply chain is what it is, and there has to be acquisition of equipment and electronics in particular from other countries. So that's one thing. And I think the other part of it is just the whole milieu around tech investing was very engagement-oriented. There was a lot of work that was being done in partnership with defense companies in Europe and defense companies in the US. Mm-hmm. And in particular, in the change that's happened globally now, there is a little bit of a difference in how those partnerships are seen, because I think people are looking for greater levels of sovereignty, and that's a very polite way of saying less business with, let's say, American companies, and more reliance on a local production in Europe. So I've been quite deeply involved with defense over the last 2 decades, and I see that is a factor. So this is a long story, but I'll just touch on those two, and we can keep going.
Yeah, we can keep going, Dana. Don't let them monopolize this whole conversation.
Yeah, I mean, I'd be lying if it wasn't a little disappointing coming into the 2025, thinking that there were going to be a lot of IPOs, and the market has certainly shifted a little bit. So I think both for ourselves and our LPs who have been waiting for a while for some of the liquidity to come in the venture capital asset class. That's been that has been a little disappointing, but we are seeing some green shoots. I think there was an IPO that priced today, in fact. So it's nice to see those things starting to happen. And I also think, it's almost like the more volatility and the more that every day there's an announcement of something, it almost starts to normalize. And so, I think the VIX is actually coming down, and I think it is interesting because it's, I think people
are you saying volatility is coming down, or we're just getting used to the pain?
Well, I think volatility is coming down because we're getting used to the pain. I mean, it's actually really interesting. I mean, I don't know, how. Anyway, I have a company that's literally like on the tarmac, waiting to go public. So, so we're watching it closely. But that's definitely been a focus. But at the same time, on the other side of things, the opportunity set truly, has never been, more incredible. And, I was telling somebody earlier, I literally, grew up in Seattle, early days of the cellular industry, listening to Chairman Carr talking about it, and we were bidding on spectrum around the world. The FCC had been sort of the initiator, and the rest of the world followed suit. And then, I was in Silicon Valley, spent a decade there, really at the early days of the internet, and this feels like that all over again. I mean, if not bigger, because of all of the waves that have come before. Mm-hmm. And so, I think on the one hand, you sort of look out and the markets feel like, geez, screech to a halt. But on the other hand, like Raj said, we're long-term investors, and we invest in the innovation economy. Mm-hmm. And if that's where, that's where you're looking. There are opportunities, probably the best opportunities of our lifetime.
Yeah, and Hemant, I would assume that you would agree. I mean, seeing everything that General Catalyst has done over the last few years, I assume you feel the same.
No, absolutely. I think there are two mega trends. There is geopolitics, and then there's applied AI. And the reality is that both of them are forcing a transformation of all the key industries. So everything we're building, whether it's transformation of the enterprise or sort of fundamentally different value propositions in industries like defense, industrials, healthcare, energy, these are massive markets all changing because they're being forced to change because of those two macro trends. So,
but are those two things complementary, or are they going to be in conflict with each other?
That's a good question. I think they are reinforcing each other. That's just the reality. And the challenge for building companies today is you have to build in these markets with consideration for your core market. So if you're a defense company in the United States, you really focus on how do you service the US market. And we have a defense prime in Europe that's really focused on European market. But we teach these companies to think about being global leaders eventually. And so I think that's threading that tension of how do you really take care of resilience needs of your local markets, but in a way that you actually will have the opportunity to be global. That's an interesting challenge in today's time.
I mean, you're very global. Is that advisable right now, given that we don't quite know how all of this is going to end?
Well, ultimately, if you invest in technology companies, what are you really investing in? People, right? And we also know that this is kind of a long tail business, the distribution of success. You want to find the outliers. So do you want to pick from a pool of 340 million, or do you want to pick from a pool of 8.5 billion? And our founder at WorldQuant, Igor Tulchinsky, has this wonderful thing that he says, which is that opportunity isn't universally distributed, but talent is. So that's been part of our ethos for a long time, and all of the people involved in the firm are very global in nature. Now, that doesn't mean that at all times every door is open to us, because there are political elements and changes that, for example, close the door on China for a while, or might close the door on some other part of the world for a while. But the world isn't going anywhere. And I think rather than having the philosophy of, this is disengagement and just sort of focus in on this one place, I think that's kind of stealing opportunity from your LPs, because the most brilliant people in the world are equally distributed, and there's a lot of them outside of wherever we happen to be. Mm-hmm. So if we want to reward our partners with the highest possible return, and we're in an intellectual property, software, hardware business where design and mind and innovation are everything, then it's our job to find the best in the world and make them part of our portfolio. And that's really the way that we think about the world.
Is the regulatory environment here in the United States, or at least the way that it might be going under the Trump administration, is that going to be conducive to what you're trying to do, Raj? I mean, we just heard from Chairman Carr. He seemed very bullish about creating an environment that could potentially be a little easier for a lot of VCs.
I think there's things that the government can definitely do in terms of clarifying. He talked about space technology. We invest in space. It's helpful to know exactly what are the rules for companies in space and to have a clear set of guidelines to operate to. But I think it's far too easy to blame the government for the woes of venture capital. I actually always think of this conference and the crowd size at the venture capital session is a good indicator of where we are in VC, and we're in a bit of a low point. This room used to be standing room only 3+ years ago, and I think we're in a bit of a lull in the industry. And to Dana's point, these low points in the industry are when we think some of the most resilient founders are building companies. And I think you're going to see profound change in VC. You're going to see that the demarcation between venture capital firms, private equity firms, really start to go away. I'll let Hemant talk about what they're doing at GC, but you're seeing a lot of firms that are starting to say that we're private capital investment firms that use AI and data as an advantage. And that's definitely the direction that we're going at in B Capital. Our focus is to really build the renaissance technologies of private market investing. And I'm fortunate that my partner, Howard Morgan, built Renaissance Technologies in public markets, and we think that AI and data is going to profoundly change the way that private market investing is done, and it's been done really kind of in an imperfect, inefficient way, and that there's going to be profound transformation over the next 5 to 10 years.
And Dana, you've applied that as well at Greycroft, right?
Yeah, absolutely. And I mean, I think it's kind of almost like any industry. If you're not starting to leverage AI and machine learning in your business, then you will probably be left behind in some way, shape, or form. So absolutely. I would also say though, and I think that for sure, the venture capital industry is maturing. I'd say somewhat institutionalizing. But at the end of the day, we're also still investing in founders, very early stage companies that still go through all of the same pain. They have to open an office, they have to sign a lease, they have, literally, like, you go through all the same things. It doesn't matter if you raised, $1 million in your seed round or $100 million in your seed round. You still have to take those same steps. And that's what, as early stage venture, I mean, we're full life cycle, but really at those earliest stages, you invest into founders and you really help them all the way along their journey. And so I think the capital side is changing for sure, but the fundamentals of the business are still very much about working closely with founders. And I think founders are looking for partners who really can, share in their journey.
Yeah.
And it's, so many things happen to you along the way. I mean, with many of the founders we've worked with, they started at, age 25 and then they get married, they have kids, they go through all sorts of things, and, they may even get divorced. We're still with them.
Yeah. Well, with what the founders want, this is a question for all of you, has that changed? Meaning, are they looking for more guidance and advice relative to maybe in the past where it was just about, getting the check and moving on? Has that changed?
For sure.
Yeah.
I really think that that founders and founding teams are looking for partnership in navigating all of these changes, because they're also, for everybody, it's sort of, okay, who should I take early stage capital from? Should I take it from a full life cycle platform? Should I take it from a seed fund? I mean, there really are, I think you can read everything. All the information about starting a company is available now. I mean, that playing field has leveled. But as far as kind of what you do with that and what that looks like day to day, there's still a lot to be done.
I feel very strongly that in particular early stage founders, we work with a lot of early stage founders, don't always know what they need and they don't always know what they want. And that is not a reflection on them, it's a reflection simply on the fact that they've never really done it before. And building a company is a complex endeavor. In other words, there is no one book or 5 books or 6 books that I can give anyone and say, this is what it feels like to build a company. It's a fundamentally combustive, consumptive, difficult, tribulation-filled experience, because there is so much complexity in this path. And now in my own case, I have built companies, and I think that that kind of entrepreneurial thinking of remembering that day when you were entirely beaten down, remembering that day when a term sheet got pulled for no reason, remembering that, those things are interesting because you can at least share what you went through and how you dealt with it. And that is visceral. So I guess what I'm trying to say is that one element of what early stage entrepreneurs need is the realization that they too will go through some tribulation. And at that time, people that are close to having experienced that tribulation are probably best suited to provide counsel. That's a huge part of entrepreneurship, just the emotional element of keeping people on target. I think that's huge. So that is one thing. The other stuff around, let me tell you, I'll connect with you 6 people in my network whom you might hire as sales guys, and I know 8 developers that I can send to you, and I have a really good real estate guy and 3 law firms. Okay, whatever. I mean, that's
not to brag, right?
That's just par for the course, whatever, But I think that domain expertise, knowing how to do the thing with your own hands, and having put your heart and mind in the same situation that this entrepreneur will likely be in, those 2 qualities allow you to be a real coach and a real mentor. But this is just my view. I have obviously experienced a long period of time where I wished for more of that, and I feel that that's something that my partner Steve and I are committed to delivering to our entrepreneurs, because I think that matters more than anything else.
Emmett, you've been quiet down there. You're very far away, by the way.
So look, I think we think about the founder proposition. Before the whole ChatGPT AI revolution, a lot of the companies that were getting built, there was sort of an archetype to it, which was these were hacker founders. You would build really good engineering teams. You would get product market fit by using distribution and all the platforms that got created since, in my opinion, since '07. And you would go build these kind of product-centric companies. If you look at what's happening now with AI, there's a fundamental shift. And the shift, again, it's about going and transforming industries. So the archetype of the founder, first of all, that does that well, is not this precise product-centric founder. It's actually somebody who knows how to navigate this ambiguity and almost treat these customers as design wins and go do a lot of things with them. So there's this whole nature of sort of compound startups getting built. The most valuable companies getting built today, they're buying stuff, they're building organically, they're very creative. And they're figuring out how to be better at partnerships with outside industries. And so the advantage around distribution and helping them get access to these markets, helping them understand how to deal with governments, because these are regulated markets, a lot of them. That's the skills that these founders are looking for, helping in this next generation. And it's very different from what it was before, which is, can you help us scale the engineering team and, a sort of growth unit economics. So it's sort of the founder proposition is changing in this next phase where you're going more into transformations of industries.
Mm-hmm. Go ahead, Dana.
I mean, I agree, but I also, I think, in the early days of the internet, when we were funding companies that were building communications networks and semiconductors, and it was sort of the same thing then. And I think, did need to have a lot of the same things. I actually think, really from sort of like '07 until just a few years ago, everything was being done at the application layer.
Yeah.
That we were all investing in, and that is a very different type of founder, like you're saying. But again, sort of fundamentally, what you go through in a founder journey, part of it is like what you actually need, the physical needs. Do you need relationships with the government? Do you need relationships with long-term funders, et cetera, with bankers, et cetera? That's one set of things. The other set of things, though, is actually just being sort of the person that they call at 11 o'clock at night when grappling with something real. And I know we all go through this and experience it, but I think that's something that is increasingly important because the world is moving. This is all moving so fast. Like, founders are having to navigate the most complex environments that I think have really ever existed. Especially when you sort of layer on the geopolitical side of things. And so, again, I don't want to overemphasize it too much, but I think that idea of partnership is a really important one, and one that it feels like, as we institutionalize as an asset class, really can't be left behind, because it's just such a critical nature of that sort of founder-funder relationship.
And the role obviously changes for what all of you are doing. I am curious about the investment side of it and whether the investment strategy has to change as well. And I'll start with you, Raj, on that.
I think it does. I think we're in a little bit of a position in venture capital that we've created ourselves, and I have a fundamental belief that there's three core things that we need to do. One is, I think we all have to be AI native as a firm in the companies we invest in, and I think VC firms are really well positioned there. The second is, we're looking more and more at inorganic growth and roll-ups in every single investment that we do, and we're working with our CEOs and our boards to focus on inorganic growth. I actually think private equity firms have an advantage there. And then the third is liquidity. We've all talked about this a lot. We have not returned the liquidity we should have. Mm-hmm. And I actually think that a lot of crossover investors, public market investors, are constantly thinking about liquidity, and they have an advantage there, which I think makes it really interesting that between VC firms with our AI native skill set, private equity firms and their inorganic growth, and a lot of crossover investors and their liquidity, I think it's a bit of an open field in terms of who are going to be the winners in the next era of technology-driven investing.
On your second point, I find interesting too, and I'll pose this to you, Emmett, because I know that some of General Catalyst deals, you've been involved in inorganic growth, to borrow Raj's phrase here. Are you seeing more of that?
Yeah. So one of the big themes, as Raj was saying around roll-ups, is everywhere over the last 40 years, we offshored for labor arbitrage. You're sort of bringing that back with AI productivity. So if you sort of think about, you know, a lot of the business departments, think about legal services or accounting or HR or call centers. We have essentially taken AI teams and we've gone and we've been buying call centers and law firms and accounting firms to say, let's go transform them and make them AI native. So I do think that transformation opportunity there is pretty substantial as the world figures out how to adopt AI into, you know, our overall business processes.
Amir?
Yeah, I think that in a different way, if you go back to, you know, early venture capital in America, if you look at, for example, Arthur Rock, Venrock, and then you look at how Apple was founded with Mike Markula, small check, and kind of people very close to the product, building the product, getting it to a point where there was some level of product market fit with a small amount of money. Over time, that changed because during the dot-com kind of explosion, you needed a lot of money to actually build a company. You know, I remember the company that I built at that time. You know, we spent tens of thousands of dollars on compact servers and tens of thousands of dollars on Oracle licenses, all of which are basically free now if you were to do that. And I'm talking, you know, that amount of money in early 2000s of dollars. So that whole thing changed, but instead of money being rationalized with compute power and capability that's needed, the money got redirected to this notion that you can just overspend and buy the market. And there were many venture capitalists who, by the way, this is not a comment on whether it was right or wrong, it's just a statement of fact. Funds like Andreessen Horowitz came up with the strategy of let's overfund a company. Let's give them so much money that it becomes very, very hard for competitors to keep up with them. Let them go and buy distribution channels. Let them do those types of things. I think that that is all turning back around. And I think that you know, on the defense side, a lot of my work has been focused on this area called hyperwar, where the idea is that the decision-action loop shrinks so quickly that war becomes instant and autonomous. So observe, orient, decide, act, that shrinks down to nothingness, and human decision-making eventually reduces from that loop. And I've, you know, over the last 20 years been thinking a lot about that, but strategy is strategy, and sometimes there are parallels in business. And I think in venture capital, what's happening is that observe the opportunity, observe the market, identify the opportunity, decide on what to do, on the strategy to follow, and then act, execute. All those four elements, the military parallel in building a company, is also now AI-enabled and is also can be augmented by a venture firm. So in some senses, what we've done over the last 15 years with hyperwar and the military, Steve and I often talk about that same type of thinking, this kind of super automated everything, minimal amounts of money, rapid PMF, and everything digital as much as possible. Including figuring out how to do that with hardware companies. Those, to me, are the innovative elements in how venture capital can look a bit different, and that it might open the door. These types of techniques, we may fail. The types of things that we're trying to do may not work, but I think they will. And if they do, they will open up the door to a more efficient way of building companies, giving entrepreneurs a little bit more time, because the more money you throw at them, in some way, you also steal from them their longevity, because the expectations that you set for them are then too large. So the emotional issues and all of that I was talking about, they all compound, and it becomes this kind of strange mess. So sometimes that leads to failure. How can you apply this new model and avoid those failure scenarios? So it's a very analytical approach. It's not just what I think. We're actually trying to debug the process and find in this venture machine what are things that can be slightly tweaked and optimized with the latest technologies that we've been able to learn over the last few decades.
Yeah, I mean, I think what you're saying is really interesting. I mean, I think one of the things that we've been thinking a lot about is just how do we kind of structure just really drive a lot of structure into as much of our business as we can. Just sort of like automate all the things that we can automate so that you have a lot of freedom to think and to be able to move quickly and sort of, pivot quickly because things are moving so fast. And I think, I really admire the way that Palantir built their business, this whole concept of kind of the forward deployed engineer. They essentially, went out and sort of built products. They were people thought forever they were a services company, and then all of a sudden they turned around and they had software products that they were, very locked in. And, I think the same is true a little bit in almost every area right now. I mean, in AI in particular, I think as large enterprises, I think what Hemant's doing, as far as actually buying companies and sort of AIifying them is super interesting. But, for our companies, really being able to sort of fund them to go out and do some of these big lighthouse customers and build with the customers is really going to be the way of this wave. We kind of need to be doing the same thing. So that's what I mean, like trying to sort of automate as much of our business as we can. And then also, one thing that's sometimes a little counterintuitive in venture, we're all, everybody thinks you just want to move fast, fund things quickly, just move fast. Strategics, they're just, they can be a headache. Don't bring strategics. I think we have to really listen to strategics right now and customers right now because we're hearing those needs in real time and being able to sort of feed those back into our portfolio companies, into our theses, is really critical because they're the ones that actually adopting AI in real time.
Raj, how are you integrating that? When I think about, space economy, which is a big focus of your fund, I would think that some of the strategies that Dana was just talking about and Amir, I think that would fit with yours as well, wouldn't it?
Yeah, I think absolutely. So, a few things. We, as a global fund, we still invest about 80% in the U.S. We still think the U.S. is one of the best markets to invest in, and especially when you get to a lot of these frontier technologies, from space technology to some of the defense technologies. We're not far away from Manhattan Beach and El Segundo, which has a great defense tech ecosystem. So it's, I think fundamentally for us, we think that while the U.S. is still the primary place that we invest in, we are believers that there are great companies that are going to be built outside the U.S., but our view is that a lot of those great companies are going to sell into the U.S. market, and so we still want to stay U.S. focused and U.S. centric. But I've got a partner who's based in Singapore who's really building AI today, not for B Capital, but he's building AI to transform the companies that we invest in.
Anyone we heard of?
You may have heard of him. He started a company before Facebook, before we started B Capital, and he was reasonably successful in that. And his view is that private market investing is just fundamentally broken, and that the future of private market investing is not passive venture capital investing, but it's actually buying businesses, integrating them, transforming them, and building bigger businesses. And the struggle with VC right now is we don't build businesses that are big enough for IPOs and for acquisitions. We've got to fix this ourselves. We have to build bigger, better businesses through roll-ups, through AI transformation, and that's what it's going to take to get out of this situation that we're in with a lack of liquidity.
I am curious about that, and particularly something you said a little bit earlier, Dana, about exits and the idea that you've got one company on the tarmac that's just kind of waiting. It's one thing to prepare them for that exit process, but once they actually do exit, your job doesn't end there. You're pushing them. It's almost like you're pushing them into an environment that I would think in many cases is going to be more challenging as a potentially public company as opposed to a private one.
Well, listen, we're big believers in following founders in that sense, and so in the case of this portfolio company, Mountain, which is filed publicly, so I'm not saying anything that's not. The founder's ready to go. He is he's the one pulling, and I think he's sort of like, yeah, the market is what it is. I know my business. I can't control the markets. I can control what I can control. I can build a great product, serve my customers, and he's so I think it's interesting. You're right. Our job doesn't end there. Sometimes we stay on the board. Sometimes we don't. But you're kind of always an informal advisor or advisor once you've worked that closely with the company. But look, I think founders really, I mean, we sort of back and track the founders, and if that's what they really want to do, and they want to go for it and go public, great. In the case of one of our portfolio companies, Scopely, which exited last year, it was a gaming business which the founder decided he really wanted to sell, and he actually did something super interesting, sold to Savvy Games, which PIF actually created Savvy Games to build the gaming industry in KSA, and bought Scopely. He really preferred to continue to build that business as a private entity, and they've absolutely continued to build that. They just actually acquired Niantic, or Pokemon Go, and are continuing to build there. And two of my partners are actually still on the board there. So again, I think it's continuing to just really be on those journeys and take a very long-term perspective.
Do you, though, and I'll pose this to you, Hemant, for those companies that maybe are champing at the bit to go public and maybe running up against a roadblock like Mountain and Mark Douglas, I mean, what do you tell them? How do you counsel them? Do you just say, just stay private, don't worry about it, or what do you do to talk them off the ledge?
So I think the venture ecosystem, to me, breaks down into like 3 categories of companies. There's the very best ones, so that I would sort of put SpaceX or Stripe, which we're big investors in, companies like that actually want to stay private for a very long time, and these companies are very, very large at this point, but they want to compound in the private markets because they can be more agile. But there's a secondary market. Their shareholders can get liquidity if they want. So it sort of functions like it's like the private Magnificent Seven or 8 of these companies. Databricks is another one. OpenAI is another one, right? And they can actually function with all the benefits of public companies because they're good. They're at scale. They own their categories. Then there's a second tier of companies which are very good companies, end up being very good return, but do have to go public, and maybe their markets aren't as large, and they do need to go earn the trust of the public market investors to get capital and scale. So I would put like Samsara, which we took public 2 years ago, in that bucket, and all the ones that are waiting right now that we want to sort of push out into the public markets. Then I think there is this long tail of companies that are like, in order to go public, you really need to be about $1 billion business growing 30% a year, so you can get the right investor base and be on a compounding trajectory. But there's a lot of them that get to like 100 and they're growing 15-20%. They have nowhere to go, and that's the industrialization or the maturation of our industry that's happening. And what we have to figure out, and we've been innovating in this area, is how to get these companies, which are some founders' life's work, important business, plays an important role, to be able to compound in the private markets and create liquidity for shareholders in the private markets, just like in other industries that does exist. You have access to private credit and tools like that to be able to do this. Our industry hasn't really matured to have that kind of financial apparatus. That needs to get created to break this logjam of gazillions of companies that are collectively in the venture ecosystem that have nowhere to go from a public IPO perspective, and frankly are too small for the big tech companies to acquire because they've all become so large.
And just to comment on, and so Hemant and I are in another working group or discussion group, whatever you call it, about this, and fundamentally for this to happen, a lot of these companies are invested with a whole slate of VC firms that are investors in them. And so what we have to start thinking about is how do we roll up and combine these bucket 3 companies and build companies that are not just scaling at 15-20%, but by getting the scale, by rationalizing the sales force and the go-to-market motion, we can get their growth back up to 30+% growth, because we all know there's just a huge difference in the exit multiple when you get to that 30% plus growth. And you could show that it's repeatable, that the go-to-market motion works and it's sustainable, then exiting these companies at these 15% growth rates where public market investors, one, don't give it attention. We've moved to passive market investing. We're not going to get the analyst coverage. So we're all better off if there's ways we can work together to do this.
Yeah, I mean, it is interesting that we talk so much about IPOs. I think that is, for most founders, true disruptor founders, right? When they start something, they are aiming to actually fundamentally change an industry. I mean, they're not looking to be acquired by someone. They're looking to displace them, and then more, right? And I think now, in this current environment, as far as the opportunity to build and then actually move into adjacencies and truly build, I think generational companies exist now more than ever. But, the reality is a tiny percentage of companies, of venture-backed companies, go public. I mean, that ever. I mean, it's like 5%. Yeah. And so, I think the reality is that the vast majority of venture exits are M&A. One thing we haven't really touched on is the fact that in the last, several years, the M&A market has been really stalled, and that actually has been because of the regulatory environment. And that's something that is shifting, and I think really positively shifting. I think part of the reason, yes, the hyperscalers are sort of too big to buy some of these companies, but also they haven't needed to. They're like, I'm going to get reviewed from a regulatory perspective. It's going to get hung up. Nobody really wants to go through that process. It destroys startups when you go through that, and then it doesn't get cleared. And so, it just really was sort of this stagnant market, and I think we're really starting to see that move, and that's a positive thing. And I do think that's more typical.
But aren't there a lot more avenues out there right now for, I guess, exits? I put that in quotation marks. Obviously IPOs were the most traditional way to go, and M&A to a certain extent, but you've certainly seen in the private equity and private credit space a lot of, let's just say, creative ways to return money without necessarily giving up the company. Are you seeing that?
I think we're seeing some. Listen, private equity had this problem more than a decade ago. They solved it. They just started selling companies to each other with the same still fundamental LP behind it. It was an innovative solution. I'm not sure it's a sustainable one. It's not necessarily the solution that I think we're all going for, but we need to solve this problem ourselves. We've done some continuity vehicles. We've done some secondary exits. But to the point that Dana made, between IPOs and strategic exits, they still remain far and away the way that most of us exit in our portfolio. And we've got to build bigger, better companies to drive those kind of exits and returns.
Yeah, I think in general, the secondary infrastructure around companies that are expected to not go public for many, many, many years just doesn't exist. And that creates a lot of problems for everyone, for founders looking to retain talent, for early stage investors, for sometimes founders themselves. And even though there are a few companies that are trying to hawk people's equity in private companies, there's no standardization as to how that equity was issued and what ROFRs and other issues that equity comes with. So it's basically something that can't be traded until the company either sells or goes public. And that was okay if you're going to wait 5 years, but if you're going to wait 14 years, then that's definitely a problem. That problem needs to be solved.
Yeah, I just want to remind the audience too, if any of you have questions for any of the 4 panelists up here, just use your QR code and submit them, and I'll relay them to the guests as soon as they come in. I do want to talk a little bit here more broadly just about innovation and that pipeline of innovation. There's been a lot of concern that you're not necessarily seeing the same amount of startup activity, the same amount of entrepreneurship. We can ascribe whatever reason we want to that. But is that something that worries you at all, that maybe we're just not seeing that same initiative that maybe we had 20 years ago, 30 years ago? Amir?
What worries me is, this is probably very politically incorrect. I'm not sure how it will be taken, but what I found is that over time, the folks that came into the software industry, the technology industry in general, most of them came in because the industry was paying really well, and it wasn't that these were the Steve Wozniaks and the Bill Gateses who woke up just wanting to code or build a computer. A lot of these were guys and gals that were driven by just the desire to be like them, to achieve the ultimate monetary goal, the success goal, not necessarily the I built this and look, it works and it's a machine, and all of the sense of pride that you have in the art of the thing. So what happened is that there's a large influx over the last 20 years of these people, and I think frankly in the COVID and related time frame, a lot of the cultures in tech companies that were destroyed were because of the companies themselves pulling in more and more such people, diluting the culture of tech companies to something that was not compatible with the culture of a tech company. Now those same people are, if you look at resumes, those same people are, I worked at this big tech company here and that big tech company there. Yeah, but are you really a tech entrepreneur? Are you really a tech innovator? Are you dreaming about motherboards and algorithms and B trees and neural networks at night? And if you're not, then you're probably not the kind of guy that wants to go build a company. But the reason you want to build a company now is because you saw 3 of your friends build companies and they made money. So the same pull that brought people into the industry and diluted the quality of the culture in the industry in tech companies has in some sense affected founder quality. This is just my view. I may be completely wrong. I don't have a scientific study. I may be totally wrong. But this is my very strongly held view. And so that to me is very off-putting. That to me is very off-putting. And I think that as an investor, we want to filter that out as soon as possible. Because it's not just off-putting to us as investors, it's also a formula for a lot of pain for this person that's coming in thinking that they're going to be a founder with no anchoring passion that is so deep and strong that will help them survive the travails and tribulations that await them.
Are you finding, Raj, I guess, lower quality pool of potential founders?
No,
No?
not at all.
No. Dana, are you?
No, I mean, I actually think what's so exciting right now is that it's kind of the opposite. Like that if you're building something today and competing, I mean, the level of technical talent that it takes to sort of compete in AI companies, in companies that are truly sort of disrupting this sort of next major wave of innovation. I mean, you have to have teams that are most technically talented in the world in this subject matter, and it's a small pool, and because they're going to be able to attract the A talent in that area, and so that's what's actually been so exciting. I mean, that's what really drives me.
Hemant, I mean, 2-1 now against Amir. Are you going to help him out here and join his team?
No, look, I think it's an insane time. Everything is changing. You've got huge opportunity in robotics. You've got, I mean, we were talking about this earlier. Everything to me is going through a transformation. Even electricity. You sit with the utility CEOs, they're saying they're going to grow 8 to 10% a year for the next 15 years. So I feel like every sector is embracing innovation, and there's an opportunity to do something different. Like we're in our own team, we're basically like, well, we can't be experts in everything. We got to sort of pick and choose a few of these areas and go deeper because it's just seductive. I mean, the flow is crazy right now. I think you feel the same way.
Yeah. I would actually say I think it's the best time I've ever seen to be an entrepreneur, and I think it's the toughest I've ever seen to be a venture capitalist.
That's interesting. Well, I'm curious then. I mean, that actually dovetails with an audience question, and that is kind of about where some of these early seed stage companies will actually be 5 to 10 years from now. I mean, you've seen what current financial conditions are like, current economic conditions are like, and you know the failure rate of early stage companies. So that is the question, and I'll just verbatim is the growing number of seed and early stage investors, where do you see them in the next 5 to 10 years? Consolidation, new market entrants, or are they just completely bumped out?
Is it investors or founders? I didn't know.
It says investors. You can answer it however you want, Dana.
Whoever asked in the audience, clarification. No, this is the problem with the venture capital panel. We sort of all agree with each other. So, look, I think, I mean, there will be a high failure rate. I mean, there always is. I think there will be. I mean, but again, what at least we're looking for, and I assume all of these guys therefore too, are extremely talented technical founders who also have a commercial, like really strong commercial go-to-market, sort of focus, and are just talent magnets. And there are not very many of those actually. I mean, there are only about 20 companies a year that go public. I mean, if you just think about it. And so there may be thousands that get funded, but there are just not that many that go on to be truly generational companies. So yeah, there's a high failure rate.
Yeah. And Raj, you said something, this idea that a good time to be an entrepreneur, not necessarily a venture capitalist. Another question is coming in here, and it's asking whether some of these VC funds, not necessarily yours, whether they've actually just gotten too large, and maybe that's part of the problem.
Yeah, I mean, I don't know about specific firms, but I think our industry has swelled and grown to a big size. And it's not just our industry, it's private equity, it's other folks, family offices, other people who invest in our space. I think there's less and less differentiation between many of the firms. The reason I think it's a great time to be a builder is I think AI is very akin to mobile and the cloud. It's going to dramatically make the experience of building companies simpler, cheaper, faster. I think you're going to see more solo solo founders. I think it's an incredible time to build a business, and the kind of resilience that you could have by building businesses lean today is better than I've ever seen in my 27 years of doing this. I think it's really tough to be a venture capitalist because one, there's so many companies coming up, and majority of these AI native companies, to your question, I think won't be around. It's not just that they'll get consolidated, or I just think they won't be around. I think it's really tough to pick who are going to be the winners right now.
Yeah.
I think there are certain spaces like foundational models where we continue to invest, but in very differentiated models that are very use case specific and much lighter than you know, the big 3 or 4 models. But I also think it's because of this challenge of, you know, you've got LPs who are demanding liquidity faster. I had a great meeting with a LP this morning who said, don't worry, it's not just about liquidity, it's only about liquidity. And I said, thanks, really appreciate the support and, you know, like the clarity, but it's also a profound it's a time of profound change in the way firms like ours work. And I'm fortunate that my partners are builders, and I think the way we're approaching it is we're building a tech company within B Capital that hopefully is going to be a value-add partner to the folks that we invest and partner with.
And Amir, I want you to address that last question too, because what you were talking about earlier about what you're looking for in a founder, it kind of gets to this idea too that a lot of VC funds, you talk about this idea, oh, people are just coming in, they just want to see how rich they can get. I mean, some of that, frankly, is also coming from the VC funds themselves. I mean, they're making it clear they just want monetary extraction. They're not trying to build.
100%. The VC industry also grew too large. And a lot of the people that were brought into the VC industry, particularly at the junior levels, and as a fund grows larger, they only have those junior people. It becomes kind of like a consulting company situation where the top founder brings in the talent, and then, you know, those guys are dealing with relatively junior people that may not have done it before. This is just the law of how these things work. And I do think that VC funds got too large, and that the blame is to be shared. But, you know, interesting comment made by Raj. I agree completely that this is the best time to build a company from a technology perspective. If you're driven, if you are technologically minded, if you have a problem in sight, no better time than to do that. But if you look at sort of the overall AI companies that come to you, and you look at what percentage of those are a chat bot for X, I mean, that alone to me tells you what the bulk of people are trying to do. And so that is not enough. So for somebody looking for a lot of money, thinking that that's enough, what are you doing? So that's what I mean. When I say quality, I'm not saying that you can't find people of high quality to invest in. I'm saying that there's a flood of people that are not high quality, and maybe that ratio has changed because that ratio is now being fed by people that were never really into technology to begin with. They were just about the opportunity, the monetary opportunity. That's just my feeling.
All right, I want to squeeze in a couple more questions before we run out of time. I think this one is a good one. It's asking, has your appetite changed for hardware companies with a SaaS component versus pure SaaS and the global supply chain influence? Who wants to take that one?
Yeah, so I think the reglobalization of supply chains does present a really interesting opportunity. You know, there's hardware, software, we don't really think that way. I mean, I think you really think about experiences. I mean, we've built companies where you have the hardware endpoints and you've got software in the middle. But the more interesting stuff in hardware right now is about this sort of onshore manufacturing and how that creates new companies. So like just last week we announced a company called Slate. Slate is a $20,000 electric vehicle, okay? Fully made in the US, onshore, the first time. And if you think about Tesla, it's way more affordable than Tesla. So you can actually have a mainstream electric car, no frills, pure hardware innovation. built off of manufacturing conglomerate that's being built called Rebuild. And I think that renaissance around these new products getting created is something that's very exciting. And for the US to compete with China, I think it needs to invest in the robotic manufacturing capabilities over the next few years. So we are closely tracking those category of companies.
And one of the things that jumped out about me at Slate, I mean, and I'll just pose this to you, Dana, was the utility of it. And so much, we see so much new technology, so many products wrapped around technology that, for lack of a better phrase, I don't know why they exist for my sort of purposes. But then you see something like Slate, and not just to highlight Slate, there are a lot of other products out there as well. You see the value in it, and it's not just, you know, the smoke and the sparklers on top of the cake.
Yeah, and I think Slate is awesome. Congratulations. But you know, going back for 1 second on the hardware question too. I mean, I think as software fundamentally drives more and more of kind of what used to be all hardware. If you think about cars, like increasingly what was done in hardware is done in software. I think that's going to be sort of a trend everywhere. And so I do think it changes the way that we think about hardware. May change the way you think about capitalizing some of these businesses, but you know, sort of fundamentally it does change that. And I think I mean, you know, again, I feel like we're VCs, we drink the Kool-Aid, of course, but I think AI really does bring, like, it is actually making technology useful for us.
Yeah.
I mean, if you think about using ChatGPT, you know, compared to even using Google search, and
right.
I mean, now Google, you know, has AI results and everything as well, but it's so much better. I mean, it's just
it is.
Right? I mean, it's
but to Mir's point too, though, how do you sort of separate kind of those companies, those AI products that truly are useful with those that are just kind of, you know, like I said, ChatGPT and some fancy wrapper?
Well, and that's where, I mean, it has to be, the technology has to work, it has to be amazing, but the user experience has to be amazing. I mean, the reason ChatGPT is where it is because of the user experience, right? And so that is the, you know, flywheel that they started that has, you know, has really worked. But I mean, I think there aren't very many of those products, and that's why it's like, I mean, I think Slate's really interesting, right? Like, when you see something like that, you're like, wow, they thought about that differently.
Yeah. Raj, I'm curious for you, like if somebody's pitching you, and not just necessarily on AI or ChatGPT, but really on any tech, I mean, how do you ensure that what they're trying to sell you is actually going to have some real long-term utility, and it's not just sort of chasing the short-term fad?
Yeah, I mean, I literally have no way to ensure anything. That's why I'm a venture capitalist. But I do fundamentally believe that even with ChatGPT, as great of a product as it is, I think the app layer on top, and this is where ChatGPT is going, I think it's the app layer and all the apps that are going to be built on top of it that's going to drive the value. That's where we're still focused on investing. We think AI in healthcare, as an example, is becoming, it used to be about 10% of where we invested, now it's 30% of where we invest at B Capital, and it's profound, the changes. Dr. David Agus, yesterday at a dinner I was at, was talking about how the shingles vaccine can prevent Alzheimer's, how that was found out through using ChatGPT, and I think we're going to have profound impact in areas like healthcare, and that's where we're going to focus more and more on over the coming decade.
We only have a minute left, just real quickly here. Just we're just going to go down the line. What's the one thing you're most hopeful about going forward in your world?
Applied AI.
Dana?
I mean, intersection of AI in so many industries.
Amir?
Physical AI, embodied AI in physical systems.
Raj?
I think the way that my 3 kids use AI to fundamentally both cheat at school, but to really remake the way that they learn. I'm so impressed by them.
All right, I think that's a great place to leave it. I really appreciate it. All 4 of you are really just a testament to the fact that VC isn't dead. There's some people really running it and running it for the better. Thanks to all of them. Let's give them a big round of applause.
Thank you.
Thank you.